All right, Bulls and Bears, let's get back into another one today. Welcome back. And economic supervision shades on today. Hope you guys are doing well. Got a lot to uncover today or cover, but really it's uncovering because there's a lot of things we need to get into that are beyond the headlines, right? If you like what we talk about here, please give us a like and subscribe if you're not already subscribed. It's very important right now to stay ahead of the financial curve. And that's what we do here on this channel. And speaking of staying ahead of the curve, our forecast has been pretty accurate for 2024. I said in the middle of the year, we were going to start seeing big signs of distress, not any collapse, not yet. I think later this year, we're likely to see some pretty big shock moves, not only in the markets, but in the economy in general. Now, how do the markets look today? Super strong. Dow Jones got past 40,000 before dropping back down some. And again, folks, there's no connection right now between Wall Street and Main Street, right? Consumers are starting to hit the wall. We talked in our last report about how consumers, 1 in 5 credit card holders right now, have maxed out. 1 in 5, folks. That's a lot. That's 20%. And you're going to start seeing big things occur because of this. Right now, stocks are still strong. Of course, the companies are reporting earnings from the first quarter, but things that happened here just recently are not going to show up until the start of the third quarter when they finally start reporting the second quarter numbers that we're in right now, right? So there's a delay, but I think it's going to be some pretty massive, shocking things that we're going to see here. Dow Jones hit 40,000, S&P 5,300, and I see a lot of comments, even on this channel. I see a lot of comments saying, "You guys are missing the boat. You're not in the stock market." Let's clarify some things. I'm still in the stock market, right? Not very heavy, not compared to what I've been over the past few years. I'd say I'm only maybe 15% of what I have been over the past few years, right? Sold off a lot of stocks, but so have a lot of other people and went to cash. Look at Warren Buffett, look at a lot of the billionaires, what they're doing, right? The writing's on the wall. It doesn't mean it's going to happen today, tomorrow, or next week, but we know things are changing and shifting. Now, as far as the gains in the stock market, I'm happy with the silver. For those of you that have been on this channel, 2000 was it 2018? Silver went under $15, and I said I'm backing the truck up. I'm loading up. Even at 16, 17, I said bye, bye, bye. I never say for you to do that. I say that's what I'm doing, right? I don't give advice here, but if you look at where we started saying buy silver under $15 and we're close to 30 now, folks, you've doubled your money in 5 or 6 years. I'd have to look back and see when it was actually under 15, but I know we spoke about it at that time. Folks, doubled your money in 5 or 6 years. The stock market hasn't done that. Real estate in most markets has not done that, right? So congratulations if you've been on this train. You've been doing very, very well. In the meantime, you've got jokers, saying how we're missing out by by not being in the stock market. But silver is a slow mover, but it's doubled your money. You're up 100%, folks. If you doubled your money, ask how many people are up 100% in their investment. You won't see very many people say that they are. Anyways, let's move on here. Of course, we want to look for investment opportunities, but just as important is staying ahead of the news or on top of the news so we can stay ahead of this so we know where to put our money, where to invest. I wouldn't invest in real estate right now. It doesn't mean that there's not people out there buying that'll be just fine. Some will, some won't, right? Every person's situation is different. Just something I wouldn't be doing right now in my position. Not that I'm not invested in real estate. I'm not going to sell off my current real estate. I'm just not going to buy any more in the current environment, right? But to each his own. Well, let's take a look at this. Walmart surges to all-time high. Earnings beat on high-income shoppers, right? So the low-income shoppers are tapped out. The high-income shoppers now have traded down from shopping at Macy's, from shopping at, let's say, Nordstrom's, down to Walmart, right? So Walmart's doing especially good because they basically absorbed, like it says here in this article, and I'll pull it up here for you. They basically absorbed a lot of the high-income buyers. Also, a lot more people doing e-commerce. And it's mixed. A lot of the high-income people are buying things with money that they have saved up. Or they're buying it on a credit card, then just paying off their credit card in full. But the majority is people putting things on credit cards and not paying it in full, right? That's one of the big reasons why the economy looks a lot better than what a lot of people are expecting, right? It's this debt driven spending. Without the debt, without the ability for money to be loaned out of these banks and increasing amounts of debt, this economy would have came down a long time ago. So the question is, with the consumers now reaching the breaking point, 1 in 5 again maxed out on the credit cards, how will the credit card companies, banks respond? Will they start cutting the limits? If they do, then you're going to start seeing a big snowball effect. But what if they respond in the opposite direction? What if they loosen the credit limits to allow the consumer to go further in debt? See what I'm saying? So when somebody's maxed out, it's a critical time for the banks. They have to start making a decision. At some point, people expect that the banks are just going to be rescued no matter what. So I wouldn't be surprised if the banks went ahead and just increased the credit limits, because they don't have to worry about defaults, because you always have the money that can be created and basically rescue these banks, right? Sad, but that's true. That's how it is, right? That's why it's really difficult to predict and forecast the economy, markets. But even with all that, we still do a pretty good job here. Average consumer carries over $6,000 credit card debt. Another CNBC article. Of course, more borrowers falling behind. Obviously, we just talked about that. But $6,000, folks, another record amount of debt, right? Where does it end, right? That's been the question we've been asking here since we started seeing the debt start to surge, is where does it end? When will the economy finally crack under the pressure of these consumers buried under so much debt, right? Some people say it's going to happen right away. I still say give it a little bit more time. CNC put this out. The average used car and new car interest rate based on your credit score. And here it is, folks. Take a look at the best credit score tier here. We've got 781 to an 850 credit score, what they call super prime. Super prime. And yet even those people are getting a 7.6% used car loan on average, 5.6 for new cars. Go down just one tier, the prime, 661 score to 780 FICO score. You're at 7% to 9.7%. I don't even want to look down there at subprime. So you've got 506 to 600, 12 to 8, almost 19%. Deep subprime. Wow. I didn't know there was deep subprime. 300 to 500 FICO score. And they're looking at between about 15 and almost 22%, folks. Should anyone that's in a super, or what do they call it? Should anyone in a deep subprime category even be able to borrow money? That's a hot topic up for debate right there, if you ask me. And when you look at the magnitude of the car loans out there, when you look at how many people have $1,000 plus car loans right now, I believe it's over 15% as of the first quarter. We'll see when this quarter number comes out. I think we're going to be over probably 17, 18%. We'll see. At some point, there's got to be a breaking point. To me, it looks like a lot of things up in the air right now that could likely come down very close together, or about at the same time. So we got the car loan tsunami happening right now. The defaults are rising. Credit card delinquencies, of course, 1 in 5 people maxed out. That's happening. Mortgages still looking pretty good in the housing market. The foreclosures are still very, very low compared to historical norms. So we may see these other things fall out before the housing market, but that could come back and bite the housing market, because when jobs start getting lost, a lot of homeowners losing their job, then you really start seeing the tsunami take out a lot of things around it. Take a look here out of the, what is it here? Hill. Rent has risen faster than wages in most U.S. cities. Folks, that's something that should not happen. Rent should be very closely aligned with incomes, because most people aren't borrowing money to pay their rent. But what people are doing is they're borrowing money in other places, taking on debt over here to be able to pay rent over there, right? If it weren't for the borrowed money over here, the landlords wouldn't be able to raise the rent over there, because people wouldn't have any money. If they had to actually pay for things with money they had saved, then rents would be dropping, because people wouldn't have any money left over for rent. But because people can borrow money, buy now, pay later, of course, credit cards, all these different loans, all these debt mechanisms, that then allows the landlords to keep raising rents. But when it finally hits a point where the consumer is done, then you're going to start to see rents dropping. So what's going to happen to rents now that 1 in 5 people are maxed out on their credit cards? Right? We already saw some dips in the wintertime. It's going back up now in the spring, but we saw some big dips in rent, bigger than the previous 5 years. And we're going to likely see this winter be even bigger. So starting, I think, in October, November, December, we're going to really start seeing a lot of things come together, hitting the fan at once, in my opinion. I'd like to know your opinion. Please let me know down in the comments what you think about all this. The gains in silver, 100% folks in 5 or 6 years. Hope you're stacking well on that one. You might want to slow down on the stacking now. Even at $30 though, when it gets to 60, $100 an ounce, you're going to be very, very happy. Either way, hope everybody's doing well. As always, let me know what you think down in the comments. Please like, share these videos, get the word out there. Tell people about economic reality if you want to get on top of the financial situation here ahead of the curve. Share this so people can join and see what's going on. Everybody, please let me know what you think. Big love. Keep stacking. Bye for now. Peace.